Let me ask you something that might sting a little. Did you think Social Security was supposed to be your safety net, money you already paid into, finally coming back to you? Well, here's the rude awakening. The IRS doesn't see it as a gift. They see it as taxable income. And for millions of retirees, that means the government takes a slice of the very check you worked your whole life to earn. Now, here's the part most folks don't realize. Whether your Social Security gets taxed or stays in your pocket depends on the decisions you make before and during retirement. I'm not talking about some shady loopholes. I'm talking about understanding the rules, playing the game smart, and making sure you don't hand Uncle Sam more than you legally owe. And with the 2026 tax changes right around the corner, the stakes just got higher. Retirees who don't plan could end up paying more in taxes than they ever expected. But those who act now can lock in powerful tax-free strategies that keep more money in their hands where it belongs. So today, we're breaking it all down. How Social Security really gets taxed, what strategies can save you thousands, and what moves you need to make before 26 hits. This isn't theory, it's your retirement lifestyle on the line. Most retirees make a big mistake when it comes to Social Security. They think, I paid into this system my whole life, so when I get my benefits, it's my money, tax-free. Sounds fair, right? Unfortunately, the IRS doesn't see it that way. The truth is, depending on how much income you have in retirement, up to 85% of your Social Security benefits can be taxable. Now, before you panic, let's break this down in simple terms. The government doesn't tax Social Security benefits across the board. Instead, they use something called all provisional income or combined income. This is basically a formula the IRS uses to figure out if your benefits should be taxed. Here's how it works. Step 1, team, take your adjusted gross income from things like pensions, 41-tick withdrawals, wages if you're still working, and investments. Step 2, add any tax-free interest like income from municipal bonds. Step 30, add half of your Social Security benefits. That total is your combined income. Now, the IRS compares that combined income against certain thresholds. For single filers below $25,000, Social Security isn't taxed. Between $25,000 to $34,000, up to 50% of your benefits are taxable. Up above $34,000, up to 85% of your benefits are taxable. For married couples filing jointly, $1,000 to no tax on benefits. Between $32,000 and $44,000, up to 50% of benefits are taxable. Above $44,000, up to 85% are taxable. Notice something. These thresholds haven't been adjusted for inflation in decades. That means more and more retirees are getting caught in the Social Security tax trap every single year, just because their cost of living went up or they saved responsibly. Let's make this real with an example. Suppose you're a married couple with 30 of zeros a year in Social Security benefits. That's a $15,000 that gets counted in the formulas. Remember, they only use half. Now add in $20,000 from your IRA withdrawals and another $10,000 in dividends. Suddenly, your combined income is $45,000. Congratulations, you're now over the $44,000 threshold, which means up to 85% of your Social Security can be taxed. And here's the kicker, you're not being taxed at 85%, but rather 85% of your benefit amount becomes taxable income, which then gets taxed at your regular rate. For many retirees, this feels like double taxation, paying tax on money they already earned during their working years. The big takeaway here is this: Social Security isn't automatically tax-free. Whether or not it gets taxed depends on how the rest of your retirement income is structured. If you're not careful, you could end up paying way more in taxes than you expected. Understanding this formula is the first step. Once you know how it works, you can start using strategies like adjusting withdrawals, building tax-free income streams, or timing your Social Security claim to keep yourself under those thresholds. Knowledge is power here. If you don't know the rules, the IRS wins by default. If you do know the rules, you can structure your retirement in a way that keeps more of your Social Security in your pocket, not Uncle Sam's. Most retirees think, well, I'll just take money from whatever account I feel like. It's all mine. Anyway, that's a dangerous mindset. If you pull from the wrong account at the wrong time, you could push your combined income higher and trigger taxes on up to 85% of your Social Security benefits. Here's the reality. Retirement isn't just about saving money, it's about distributing it wisely. the traditional order and why it hurts. A lot of people start tapping into their 401k or traditional IRA first because that's where most of their savings are. But every dollar you take out of those accounts is fully taxable income. Stack that on top of your Social Security and boom, you've crossed the IRS thresholds. Let's say you need $40,000 to cover your expenses. If you pull $25,000 from your IRA and you're already receiving $20,000 from Social Security, the IRS formula counts half of your Social Security at $10,000 plus your IRA withdrawal. That's $35,000 combined income. Married, you're right at the line. Add just a bit more and you're in the 85% taxable zone. The smarter way, layer your withdrawals. Instead of defaulting to your taxable accounts, consider layering your withdrawals. Think of it like playing chess. You're thinking several moves ahead. Taxable accounts first, use money from brokerage accounts with long-term capital gains or just your savings. This kind of income often gets taxed at lower rates and doesn't hit the Social Security formula as hard. Roth accounts, Roth IRAs or Roth 401ks are powerful here. Withdrawals don't count toward your combined income, which means they won't push your Social Security into taxable territory. Traditional accounts last. Save your IRA or 401k withdrawals for when you need them strategically or in years where your taxable income is naturally lower. This layered approach can stretch your money further and keep your Social Security as tax-free as possible. Timing is everything. Here's another tactic: delaying Social Security. If you have other resources to live on in your early retirement years, consider waiting until age 70 to claim. Your monthly benefit grows and you can spend down taxable accounts in the meantime, reducing the size of your future required minimum distributions at RMDs. That way, when you finally take Social Security, you'll be in a better position to avoid heavy taxation. Real life example, imagine you need $50,000 this year. Instead of pulling $30,000 from your II and adding that to your $20,000 Social Security, which would push most of your benefits into the taxable zone, you could take $10,000 from your Roth, $15,000 from taxable investments, and only $5,000 from your IRA. Same $50,000 lifestyle, but your combined income is much lower. That keeps more of your Social Security in your pocket, not the government's. The bottom line, strategic withdrawals are one of the most overlooked parts of retirement planning. But once you realize the IRS is watching your combined income like a hawk, you see why it matters so much. It's not about hoarding money. It's about using the right money at the right time. Do it wrong and you pay more tax. Do it right and you could save thousands every single year. If you want to keep the IRS from taking a bite out of your Social Security, you've got to understand one thing: not all income is treated the same. Some income counts toward your combined income formula and some doesn't. That's where Roth accounts and other tax-free buckets come in. They give you income that won't trigger taxation on your benefits. Why Roth accounts are game changers? Here's the magic of a Roth IRA or Roth 401k. You put money in after paying taxes, it grows tax-free. And when you take it out in retirement, the withdrawals don't count as taxable income. That means every dollar you pull from a Roth doesn't add to your combined income and won't push your Social Security into the taxable zone. Think of it like having a secret door to retirement income. The IRS doesn't knock when you pull from a Roth. Now, here's the catch: you've got to build this bucket before retirement. That means either contributing directly to a Roth while you're working or converting some of your traditional IRA 401s now into a Roth. Conversions do trigger taxes in the year you do them, but if you plan it right, especially before 2026 when tax rates are expected to rise, you can pay tax now at a lower rate and enjoy tax-free withdrawals later. Other tax-free buckets, Roths aren't the only option. Smart retirees diversify their income sources across different tax buckets. Municipal bonds. Interest from municipal bonds is generally tax-free at the federal level and often at the state level too. Better yet, this interest doesn't count toward your combined income formula. Health savings accounts, AHSAs, if used for qualified medical expenses, HSA withdrawals are tax-free. Considering healthcare is a major cost in retirement, this can be a powerful tool. Cash value life insurance, certain policies allow you to take out loans or withdrawals tax-free. Not for everyone, but it can be another tool to reduce taxable income. Each of these sources provides flexibility, income you can tap into without inflating your combined income. The power of mixing buckets Imagine having three buckets in retirement: a taxable bucket, brokerage accounts, dividends at tax; deferred bucket, a traditional IRA 401k; a tax-free bucket, Roth IRA, HSA, municipal bonds. If you only have the tax-deferred bucket, almost every withdrawal raises your taxable income and risks taxing your Social Security. But if you've got a Roth or tax-free bucket, you can pull from that instead when you're close to the IRS thresholds. That flexibility could mean the difference between paying taxes on 85% of your benefits or none at all. Real life examples say you need 40,000 this year. If you take 20,000 from your IRA and 20,000 from Social Security, you might trigger tax on 85% of your Social Security. But if you split it, 10,000 from your Roth, 10,000 from your IRA and 20,000 Social Security, your combined income is much lower. The Roth withdrawals don't count, so you've just sidestepped a tax bill. Bottom line, the IRS plays by formulas. If you want to win, you need options. Roth accounts and other tax-free buckets give you those options. They let you design your income in retirement in a way that keeps your Social Security safe from heavy taxation. And the sooner you start building these buckets, especially before 2026, the better off you'll be. If there's one thing retirees can't afford to ignore right now, it's the year 2026. Why? Because when the 2017 Tax Cuts and Jobs Act expires, the tax brackets are set to reset to higher levels. That means everything from your Social Security to your retirement withdrawals could face a bigger tax bite if you don't plan ahead. The expiration of lower tax rates. Right now, you're living in one of the lowest tax environments in US history. The 2017 tax law temporarily reduced federal income tax brackets, but those cuts were never permanent. Unless Congress steps in, and let's be real, you don't want to bet your retirement on politicians. Tax rates go back up in 2026. Here's what that looks like. The 12% bracket jumped back to 8%, the 22% bracket rises to 25%, the 24% bracket goes up to 28%.
Doesn't sound huge, it is.
Because we're not talking about a few extra dollars, we're talking about every taxable dollar you withdraw in retirement potentially costing you more. And remember, higher taxes on withdrawals can also push your combined income higher, which means a bigger chunk of your Social Security becomes taxable. The double hit on retirees, think about it like this. You'll pay more tax on your IRA or 401k withdrawals. Those higher withdrawals may cause a bigger portion of your Social Security to get taxed. That's a 1-2 punch straight to your retirement income. Why acting now matters. Here's the good news. You still have time. Between now and the end of 2025, retirees and pre-retirees have a window of opportunity. You can take advantage of today's lower tax brackets to reposition your income for the future. Some smart moves include Roth conversions, pay taxes now at today's lower rates and shift money into a Roth IRA where future withdrawals won't count against your Social Security. Strategic withdrawals. Intentionally take slightly larger distributions in 2024-2025 to reduce the size of future required minimum distributions, RMDs. This might sound counterintuitive, pay more tax now. But if you're paying at 22% instead of 28% later, you're actually saving yourself money. Tax-free buckets build up alternative income streams. Roth accounts, municipal bonds, HSAs before the brackets rise. Real life scenario, picture this, you're on the 22% bracket today. You convert to 50,000 from your traditional IRA to a Roth. You'll owe about 11,000 in taxes this year. Painful, maybe. But fast forward to 2026, when that same 50,000 withdrawal would be taxed at 25% or even higher, you'd owe a 12,500 or more. Plus, with the Roth, you've moved that money into a tax-free zone, meaning future withdrawals don't add to your combined income or tax your Social Security. That's a win-win. The bottom line, the clock is ticking. By 2026, the rules change, and if you're not prepared, your retirement income could take a permanent hit. The people who win in this game aren't the ones who complain about taxes. They're the ones who learn the rules and act before it's too late. So here's the takeaway. Don't wait until 2026 shows up on your doorstep. Plan now. Use today's lower brackets to reposition your money, reduce future taxes, and protect your Social Security. Because once that window closes, you'll be stuck paying whatever Uncle Sam demands. And trust me, he never asks for less.